Hey guys, Jeff Kamke here with Wealth Energetics. In today's video, I want to go over term life insurance and is it really the cheaper alternative that folks like Dave Ramsey purport it to be, or are there some other things that you want to consider? Now, I'm going to try to be very balanced here and show pros and cons because there's definitely valuable times where term life insurance fits the need. It is the right product at the right time for the right goals and situation for someone. Absolutely, we write term insurance for the right client. We also write whole life for the right client when it's the right thing at the right time for the right goals for the right situation, right? So let's get into this a little bit because there tends to be some misguided things around term life insurance that a lot of times we're only given half the story. You've probably heard me talk about that in other training videos where a lot of marketing in today's financial world is giving half truths, only part of the puzzle, only the part that fits a certain narrative or a certain belief system, or it's easy to market or it has the highest commission. There can be a lot of things that's very hard to discern your way through. It's a lot like what supplement is best to take, right? You can listen to 100 different people, and one will tell you it's Herbalife, another one will tell you it's longevity. Another one will tell you it's Visalis. I don't even know if Visalis is around anymore, but you get the idea. So let's dig into this a little bit and try to cut through the shaft a little bit. I'm going to pull up an illustration here on a policy that we've quoted recently for a client on the term side. And I'm going to just give you some ideas to throw around, and you can resonate with certain pieces of the puzzle when it relates to term. You're going to maybe relate to other pieces when it comes to whole life. And, part of what we do is sit down with every individual person so we can navigate this whole thing together and make sure that we're doing the right thing for you, not just the right thing that might be because it pads my pocket the most or helps me get that incentive trip, right? It's about making sure it's aligned for what you're doing. And that's part of why we go into a whole very in comprehensive process when we're working with someone to really get a good feel for who they are, what's going on in their life, how much money is coming in, how much money is going out, are they in debt, what kind of, what phase of life are they in, do they have a business, are they W-2? There's a lot of variables and factors that play into making the right decision for this. And it really comes down to you, the client, doing what feels best to you, but only once you have all the data, all the facts, different strategies, you can pick which one works the best for you, maybe with some suggestions, maybe with some professional opinions in there. But, I'm not a financial advisor, so I can't tell you what to do. We can offer strategies and you can pick what works best for you. So with that, let's talk a little bit about term versus whole life. So a lot of times term life insurance is purported to be the cheaper alternative. You would never want to have a whole life policy because for a certain level of death benefit, you can buy a whole lot cheaper, that same amount of death benefit on a term policy. So right there makes no sense. So never even think about whole life again. And I would say, pump the brakes. Hold on. Wait a minute. Wait, just a minute. I had a conversation this weekend with a good lifelong friend of mine. We got talking about this kind of stuff, and we haven't seen each other a lot in the last 10 or 15 years. So we were together, and he didn't know a whole lot about what I'm doing now with wealth energetics and with financial strategies and wealth strategies. So we got into this whole concept, and he asked me, he's like, Jeff, my colleagues at work tell me that I made a bad choice by buying a whole life policy because I could be getting a better rate of return, in a mutual fund or in my 401k or in a Roth, right? And so we went into a whole conversation about that, and I talk about that in other videos on this channel. So make sure you look for those on the channel because I do go into that whole idea about what makes the most sense. Is whole life an investment? Look for that video. So we're not going to get into that, but it brings me to the point of what are the whole reasons why we would use whole life. And there's a whole lot of them. I'm using whole here on purpose. There's many, many reasons why we use whole life. And when it comes to term life insurance, there's usually maybe one or two reasons we would use a term life insurance policy. The first one might be because, well, I can't afford anything higher. Okay. Well, that makes absolutely sense to get your foot into the door, to lock in your insurability, which means you're younger, which means insurance costs less when you're younger, and you're usually healthier, which also means you're going to get a better rating, which means you're going to get more coverage for less dollars. So that's what locking in your insurability means, is it's going to get you something cheaper that's going to pay dividends down the road because you don't have to pay for it later at a higher rate. So that's really number one, why we want to do that. Now, there can be other situations where we don't need to have a permanent policy for a long time. So there's things that we like to do alternatively is keeping a good financial foundation with a whole life if it meets your right strategies. And you can actually incorporate term into that, or we can do a separate policy. Maybe it's for a certain section of years. Maybe it's for, sorry, I got a fly flying in my face. Maybe it's for a certain number of years while you have a mortgage. Maybe it's, in a business startup phase. There can be a lot of reasons to have a term policy that make financial sense for you, and that you know that maybe after 10 or 20 years, that's going to fall off. You're not going to keep it going. And it just serves the purpose that it does. But your human life value and all the other benefits that a whole life policy creates for you, that doesn't fall away. That's usually the bedrock that we want financial foundation to be on. And again, go back and watch some other videos. I'm not going to go into the whole thing around whole life. There's so much content on this channel that talks about the profound benefits of whole life, but just know it as a foundational asset. It moves with you through life. It solves problems along the way, and it fills gaps in a traditional financial plan that no other asset or financial instrument can do. And so it's really the most efficient way for you to put in $1 and get 2, 3, 4 benefits, maybe even more than that, out of that $1. So it's about efficiency. It's about that foundation for your financial life to be able to amplify other things that you're doing and just make everything in your life financially improve because you've got a strong foundation in whole life. So that's what I'm going to say about that. Let's go back to term life insurance, because one of the big things that frustrates me in the industry is everybody talks about your first term, whether it's a 10-year term, 15-year term, 20-year term, you can even, I think, go up to 30, 35-year terms. Everybody says it's the cheapest, and they compare this one window. They look at this one section of time, compare that number to a whole life policy, and say, see, it's way cheaper for the comparable amount of death benefit. For $500,000 death benefit in a term life policy, maybe it's $100 a month. Well, that same one for a whole life is $1,000 a month. So you're getting ripped off with whole life, so you always buy term. Well, there's some other things that you might want to consider. So yes, it's cheaper up front. Like I said, we're kind of looking at it with blinders on. We're being very specific in the time frame we're looking at. That's not the only thing to consider. So let me do a quick screen share here, because I want to share with you the rest of the story, if you will, because here's what happens. We have let me make this bigger here. So we have, you can see here in this illustration, this is for a gentleman. He's 50, and this is about $58 a month, or $680 per year. It was a 10-year term is what we quoted him for $200,000 worth of death benefit. Now, as you can see, those first 10 years absolutely are accurate and correct. It is very, very cheap. And if I were to pull up a competing or a comparable whole life policy with $200,000 of death benefit, it certainly would not be $680, it'd be considerably more. But here's the part that they always leave out. What about after the first term? What about, and I read this in Dave Ramsey Facebook post comments all the time, there are people in there that say, my life didn't go quite as planned. I didn't have the opportunity to save. Life got in the way. I had an accident. I had a health condition. I had a divorce. My business didn't expand. My hours got cut. There's all kinds of things that people have in their life that is just a normal part of life that it negatively affects our ability to put money away and do the things that we want and have the pile of money that's going to be able to take over after our first term is up, to where what Dave Ramsey would call and Primerica reps would call your self-insured, which means your big pile of money, your assets, your investments can basically take over that $200,000 death benefit. You no longer need this coverage because you have a big pile of cash. And there's a big error in that. There's a big error because with insurance, the whole point of insurance is to indemnify a loss, which just means that, let's use a house as an example. If you live in a $250,000 house and it burns to the ground, you could be self-insured, but in order to do that, you need to have $250,000 in a savings account, so that the moment that it burned down, you could go pull that $250,000 and build a new house. So that's $1 of coverage, in your savings account for $1 of benefit. $250,000 in your savings gives you $250,000 of self-insured house insurance, right? And that's obviously not the way it works, but that gives you a good idea. So when it comes to you and your human life value, your ability to produce as a human being, produce income, produce revenue, produce value in the world, there's a certain number that's based on that. And it's usually your calculation of your annual income number, depending on your age. It could be 20 times that, 30 times that, just really depends. So that number if you're talking about being self-insured, if you want to have a $200,000 death benefit and you're going to be truly self-insured, that means your investments, and ideally not even your investments, because those are a lot harder to get to. You have to pay taxes. If you access certain like retirement accounts before 59 and a half, you have early withdrawal penalties of 10%. So your liquidity and your access to that money really kind of takes away from a true self-insurance. But let's just say you are self-insured and you have that money liquid in a savings account. You would need $200 or $200,000 in order to do that. So again, it's a dollar for dollar. But when we pay into insurance, life insurance, car insurance, house insurance, you're paying pennies on the dollar for that coverage. So it's more efficient. You have the rest of your dollars. You're paying, 1 cent, 10 cents per dollar for coverage. Then you can take that other 99 cents or 90 cents and go do other things with it. You can grow money, you can grow yourself, you can put it in your business, you can invest with it. There's a lot of different plays, obviously, you can make with those extra dollars. And so it becomes an efficiency move. It's all about efficiency, making your dollars go further. And that's why we do insurance. So when we're looking at this type of a thing where we're talking term insurance, yes, it's very cheap in the first term, but then it becomes very, very expensive after that. If you see here in year 11, it becomes almost, a little over $4,100 per year that it costs, and it goes up significantly every single year. By the time you're 65, it's $6,200. By the time you're 70, it's $10,275. By the time you're 75, it's 18,500 dollars. So it jumps up considerably. And so back to, Dave Ramsey saying that the first term is always cheaper, and then reading those comments, there are people that they get into year 11 and they need the insurance because they don't have $200,000 of liquid money. They don't even have 100,000. They might even have $10,000 saved up, to where if they lost their income, their family would be in a really bad situation. And I think everybody across the board, including Dave Ramsey and many of the talking heads in the financial media, certainly say you need life insurance coverage to replace your income so that you don't leave your family in a worse off position if you were to go. So here's the problem that I read a lot is people can't afford $4,100 in year 11 in this example. And so then they're stuck between a rock and a hard place. What do they do? They can't afford $4,100, but they need the coverage. So that is the pickle. That is the situation that a lot of people can find themselves in. If life doesn't go all to plan, they don't grow this massive pile of money to be self-insured, then what? Well, then it becomes almost where you're pricing yourself out of being able to use it. And then the truth of term life insurance is so cheap, always buy that instead of whole life. Well, I don't agree with ever planning in this situation for best case scenario. I say let's plan for worst case scenario. If everything doesn't go to plan, what is your plan to make sure that your family is taken care of, that you still have a good financial foundation, you're still having the efficiencies built into your financial plan because you have a rock solid piece, which we would recommend being whole life insurance. And it's not just any type of whole life insurance. And I was talking to my friend, like I said, this weekend, and he had a very, traditional type of whole life insurance built for him that doesn't give him like hardly any of the benefits that I was explaining to him that could be there if it was designed in a more optimal way, where there's much more cash value, there's much more liquidity to the money that you're putting in. Your death benefit goes up every single year. Your cash value is growing every year. There's a lot of things that we do very specific to every client to tailor these policies specifically for them and their needs and their goals. And that's something that it doesn't happen probably in 90% of the cases out there. It's just not done. So I don't know if it's an ignorance play on the play of the insurance agent, or if it's they're trying to go after a higher commission. I don't know what the situation is. It may just be a lack of education into really how to use a tool. So I think like with any industry, there's probably a top 10 or 20% of people that really know how to use the tools of the trade the way that they do. So whether it's drywall people, whether that's carpentry, whether that's lawn care, whether that's roofing, like doesn't matter. There's usually a top few percent that really know what to do, and that carries over into whole life insurance as well. So when we're talking about, having this bedrock, that's what we recommend. And part of the reason for that is in this situation here, a whole life insurance policy, you have a little, we usually design them so there's a little flexibility in what you're paying into them. You can pay more if you've got it, or you can drop back down to the required minimum level. That gives flexibility. So if you have cash flow changes, you're not going to come into risk of lapsing your policy or losing your policy. But the whole idea with a whole life is it's taking all these numbers that you see here, whatever the year by year amount is for that death benefit, the rate of insurance would be for that level of death benefit, it doesn't increase every year based on like that year, looking at that year and what is the risk calculation for that amount of death benefit this year and next year and the next year, where it's going to go up because you're closer to passing away. Whole life takes the whole number and divides it evenly across the number of years you would have the policy, usually up until age 121 is what most of the carriers we use do. So you're getting an even death benefit. So there isn't this major increase. You're paying more in the beginning, but less later on. It all evens out, but you're getting all the other benefits that come with it. And so that's one of the biggest things that I like to point out, and is so foundational to the discussion here, because as you look here at this other column, we have $200,000 of death benefit. If somebody were to have this policy for just, about 27, 28 years right here, the cumulative premium, which means the premium you've paid year one gets added to year two and so forth, all the way down at year, 27, you've paid $193,000 of death benefit for $200,000 of coverage. And then after that, you're paying more for the coverage, then the coverage is even worse. So it doesn't even make mathematical sense to keep something like this. You're better off putting money under the mattress because it just doesn't benefit you. And so these are some things that I wish the Dave Ramseys would point out and educate clients on this, because somebody might look at this and go, yes, this is absolutely right. I need that first 10 year or 15 or 20 year because it's a lot cheaper. It fits my budget. My business is growing. I'm just starting a family. There's a lot of factors that we want to get our foot in the door and do the lower premium. But then after that, it doesn't make a lot of sense. And there's others of you that are going to look at this and go, oh my gosh, Jeff, I didn't know that it looked like this. I didn't know that this kind of thing was going on. I didn't know that this was what I was up against, where I'm basically going to put myself out of reach by year 11, or in other policies that are longer, it might be year 21 or it might be year 16, that the premium jumps considerably, a lot of times 5, 10 times the premium jumps from that first level period that you're paying, like in this case, the first 10 years that are $679. After that, it jumps significantly, and people just aren't aware of that. And they're not given their alternatives, not giving the full education around when you use one over the other. And that's what I'm aiming to do with this video and the other content on this channel, is give you the education so you can make an informed decision that's right for you. Because, term life insurance is very, very powerful because it's doing that one thing very well. What we like to do is, if somebody needs the lower price point of the term, is do something called convertible term, where it gives you the option within the first number of years to convert a part or all of it over to whole life insurance, so you can begin getting the other benefits that whole life brings with it, where it could be, part of a college planning strategy. It could be, capital for your business. It could be the banking for your family, where, everybody comes to you excuse me, to fund other things that the family needs. And obviously you'd have to have a pretty large policy to do that. It can serve as a cash stream in retirement that's tax-free, that can be something you pull from when the market's down in your other investments, that you don't want to, double dip and take a withdrawal and have the downturn in the economy in that year and lose, even a higher percentage of your principal. And there's other things where you can access your death benefit early. It's called a living benefit, where you can access, if you have a chronic illness or a terminal illness, you can get access to a portion of your death benefit to go get maybe alternative care. Maybe you don't agree with drugs and surgery and chemotherapy, and you want to go seek alternative treatment to get to the root cause of your problem. Things like term with living benefits, or a whole life insurance policy that has living benefits with it, give you that ability. And it can also serve as almost like long-term care, but it's not quite long-term care, where you're using the death benefit to function as a long-term care. So you can begin to see how whole life is this very flexible financial asset that can go with you throughout your whole life, solve different problems at different times throughout your financial life. It fills gaps in financial plans, and I go into other videos about some of those gaps that it covers. Because it's very instrumental to understand the holistic picture of what your money is doing. Rate of return isn't going to solve all of your problems. And if it does, it's going to take more than, pennies on the dollar to get you there. It's so much more efficient for your dollars to be spent, some in insurance, maybe some with annuities. And there's a lot of different factors that play into what your strategy would look like, but it's way more efficient many times to use products that are efficient so the other dollars that you have can go do other things and a lot of times grow better because you're being more efficient in other areas. So hopefully this gives you a good, well-rounded understanding of, the pros and the cons. There's probably other ones that I'm not touching on in this video, but again, if you're looking for term, convertible term may be a really good option because it gives you that convertibility. But then if you want term life insurance, make sure you're getting living benefits term. And if you don't know where to go from that, definitely message me or click the link in the description to schedule a call with me, and we can look at your options are, because the living benefits, and I'll give you this story, I've given it in other videos. Our agency owner, my mentor, Chris, his father-in-law had a term policy with living benefits, and he is still alive to this day solely because of that policy. If he did not have that policy, he would not have been able to have the large amount of money that he gained access to go seek alternative cancer treatments from a stage 4, I believe, stage 3 or stage 4 pancreatic cancer diagnosis, which is usually an almost instantaneous death sentence. You have months to live, and that's it. And he's still living 4 years later, plays golf 4 days a week. And it's because of having the right product that's going to give you more coverage, it's going to do more things for those dollars, depending on what your situation is. Again, if everything doesn't go perfectly in your life, then you're planning for the worst case scenario. You've got the coverage, you've got options that you can literally come down to being the difference between life and death because you got the right product and it can serve the function that it needs in your life when you need it most. So again, that's really what I want to talk about in this video. It's very, very important to understand, when does this make sense for you? When does it not? To do term life insurance, yes, it can be cheaper, but there's a trade-off down the road that is very important for you to understand and know, can you even afford it financially? And a lot of times it makes sense to have more permanent coverage. And the reason for that is, even if you don't want to pay all your whole life, there's many options that, again, I wish Dave Ramsey educated his client base on this. You can do sometimes a single pay whole life insurance policy where you pay one time, you have coverage for life. It gives you a certain level of death benefit. The cash value grows over time. The death benefit may grow over time. You can also do 5 pay, 10 pays where you pay 5 payments over 5 years, 10 payments over 10 years, and you stop paying. If you've got a whole life insurance policy and maybe you're in a real tight bind, you've had it for 7 years, you can do something called a reduced paid up. So it means whatever the amount of premium you've put into the policy, that amount would give you a certain number of death benefit at 7 years. And it could be after 7 years, but 7 years is the minimum. And you could basically lock in that amount of insurance that you've already paid for. You don't have to pay any more, but you'll never lose the policy. So there are some really good alternatives so that you're getting the full coverage for your lifetime without having to pay your whole life. There's a lot of options, and this goes back to working with somebody that knows all the options, that knows the industry, that isn't focused on one aspect, excuse me, or one belief system around one type of product that may not be right for you. So hopefully this was educational. Leave me a comment so I can see if this is helpful for you to know the difference between whole life and term. And maybe if you need to know which one's going to work best for you, schedule a call. My link's in the bio. I'd be happy to schedule a call with you, go over your options, look at your situation, and make some strategy recommendations on what might work good for you. And again, make sure you're subscribed to this YouTube channel, so anytime I come out with new videos around wealth strategies or anything related to finance, just to empower you, to help you on your pursuit of success and abundance with your money, or doing the inner work, because to me, they go hand in hand. That's why I named the company Wealth Energetics, because it's about building wealth. It's the strategies to help get you there and the mindset to help get you there. But it's also about doing the inner work so that you become the better version of yourself and discard the things that aren't truly you, right? We have a lot of those things from childhood, things that we've experienced, traumas, stuck energy, a lot of things subconsciously that are holding us back. And so that is a big part of what we're doing here. So there's content on this channel that looks at both. It talks about both, gives you really good strategies, really good information, really good education around both aspects. So hopefully you find something here that's going to be beneficial for you and can really take you to the next level in your pursuit of abundance. So until the next video, guys, make it a great day, and we'll talk to you soon. Bye-bye.